All right, today we're going to talk about Chapter 5, which focuses on course behavior. Now, this shouldn't come as a surprise to you, but this is what we're going to be talking about every week, is costs. So you might think, didn't we talk about this already? Yes, and we're going to continue to talk about it throughout the semester and add different dimensions to the topics and different levels of complexity. So some of what we're going to talk about today, believe it or not, has to do with variable costs, fixed costs, and you're probably thinking, how much of this can I take? Right? Olga. But that's what we're going to be talking about. So that's the focus of Chapter 5. But it's a little bit more involved. It introduces for the first time the idea that some costs can be what we call mixed costs, which means that they can be both fixed and variable. And what I want to do is first go over an example with you, which is the first example in the book, which in Chapter 5 is page 228, which really highlights and illustrates what we talked about last time, which is the fact that the variable cost per unit is constant. So the variable cost per unit is constant, but the total variable cost is going to increase with the level of activity. So we've talked about this before. And today we're going to take an example. We're going to look at this example as it relates to coffee. And we're going to see how what we discussed last time plays out in this particular example, which is we also talked about fixed costs. Remember we had that discussion? Melissa raised the point about fixed costs. She said, wait, explain it again. And we had a discussion about that, some clarification about how the total fixed costs within a relevant range doesn't change. However, the amount that each unit absorbs is going to decrease as the level of activity increases. And that's what this example illustrates. I want to go over that with you because it really brings to life what we just described. All right, so let's look at this. This is on page 228. This is an example about coffee. Anybody here drink coffee? Who here drinks coffee? Let's see. Almost everybody. What about you, Mary? You don't drink coffee? You're already too hyper? Right? You got that? Do you drink coffee?
No, only green tea.
Only green tea? That's interesting. That's good. No, I'm just wondering. No, I'm just answering. No, I'm just asking, to see. What about you, Crystal? Do you drink coffee? All right. But it seems like most of you drink coffee. What about, how many of you drink Starbucks? And how many of you drink Dunkin' Donuts? So Starbucks people, raise your hand. Wow, there's quite a few. What about Dunkin' Donuts? What about, how many don't care? Dunkin' Donuts, Starbucks, doesn't matter, either one? It's the same? Do you think the Starbucks coffee is stronger?
Stronger.
Yes.
Yeah, it is a bit stronger. I remember the last time I went into a Starbucks, which usually I don't get coffee in Starbucks. In fact, I usually don't drink coffee much at all anymore, just for the flavor, just for the experience. I don't drink it anymore for the caffeine. Now I just get caffeine injections instead. That's the level that I'm at. I used to drink 10 double cups of coffee a day. So now, look. So I'm off coffee. But the last time that I went in there, in fact, the one right over here, I told them I wanted a vanilla grande. And you need to have a dictionary to go in there to order, right? Because they have all these different terms and so forth. So You got to be careful. So I told her I wanted it sweet. I like coffee that's sweet. And so she gave me the coffee. And then I took a quick sip before I left. I said, oh, I'm sorry. I don't mean to trouble you, but I said, but you forgot to put the vanilla in there. She says, no, I put the vanilla in there. She said, that's the way we make it here. I said, oh, yeah, now I remember why I stopped coming to Starbucks. Because, yeah, the coffee is a little too strong for me. But anyway, let's see what happens at this company called Espresso Express. Right, that's the name of the company. Espresso Express operates a number of espresso coffee stands in a busy suburban mall. The fixed weekly expense of a coffee stand is $1,200. So we have the fixed weekly expense is $1,200, and the variable cost per cup of coffee served is 22 cents. So we're talking about the cost here. We're the operators, right? This is our business. So it's telling us that the fixed cost is $1,200 and the variable cost is 22 cents. So let's see how this plays out. What they want us to do is to fill out this table, and then what we're going to see is the impact on the average cost per cup. All right, so let's put this chart up there. So they tell us the fixed cost. That's the total fixed cost, right? Then they tell us the cups of coffee per week. Now remember when we were talking about that sensitivity analysis? Look what we're going to look at here. 2,000 cups, 2,100 cups, 2,200 cups. That's the cups of coffee per week. Now what is the fixed cost at 2,000 cups of coffee per week? Fixed cost, 1,200. So when we make 2,000 cups of coffee per week, our fixed cost is 1,200. Now what about if we have a good week and more people are starting to drink coffee and come to our espresso, what do they call themselves? Espresso Express. There you go. Now we have, this week we sold 2,100 cups of coffee. So that's nice, right? That's a nice increase in business. 100 more cups this week. What is our fixed cost now? Are you sure? Okay, 1,200. And for 2,200 cups? Also 1,200. All right, they tell us the variable cost per cup is 22 cents, right? So 22 cents per cup. But now what we're going to look at is the total variable cost. That's actually what we're going to show on this chart. The unit variable cost is 22 cents, but the total variable cost is going to be what for 2,000 cups? $440. Right, $440. And what about, now watch, for 2,100 cups, what is going to be the total variable cost?
462.
Somebody?
462.
462. And for 2,200 cups?
484.
484. So this is what we had just said, right? Total fixed costs are going to remain constant even when we're seeing an increase in the level of activity, which in this case means we're selling more cups of coffee. And the unit variable cost is still 22 cents within this relevant range. Why? What does that mean when we say it's 22 cents within this relevant range?
We charge per
But how come it's not 25 cents? Well, how come it's not 20 cents? Go ahead, Mackenzie.
Wouldn't that be an assumption that every cup is made the same way, same size, same amounts? They're constant, identical, or I should say similar batches of coffee every time.
Right, absolutely. That's definitely a big part of it. And remember, we said previously that we're assuming that within this relevant range, which in this case we could say between 2,000 and 2,200, or it could be between 2,000 and 20,000 cups, that our cost is not going to change, our variable cost. So in other words, we're assuming that we're not getting any type of discount on the purchase of the coffee. That's why it's so important to remember that there is a relevant range. Even for fixed costs, there's a relevant range. So we say the costs are fixed. Yes, the costs are fixed up until 25 million units. Why? Well, why? What's going to happen if we go above 25 million units? What could the implications possibly be that would change our fixed cost? What could happen after 25 million units? Or 50 million units? Because in every organization, the relevant range is going to be different. But let's say for our example, what could happen if we reach the upper limit of our relevant range, which let's say is 25 million? Why would the total fixed cost change? So what are some examples of fixed cost?
Rent, insurance.
And so remember, what did we say about insurance? Why did we say, well, insurance might go up? Why would the insurance go up if we make more than 25 million units?
Safety issues, I mean, you're producing?
Yeah, there could be some risk. The insurance company could perceive a greater risk. So up until 25 million units, we're going to pay a certain amount for insurance. And that might be, let's say, $100,000 a year. That's what the company has to pay. And that's a fixed cost, right? Because we said that whether we make 1 million units, or 5 million units, or 10 million units, or 15 million units, our insurance is still $100,000 a year. But then we said within a relevant range. But now, what I'm reminding you is that if we go beyond the relevant range, like in this case, if we make more than 25 million units, then our fixed cost could actually increase. Although we said fixed costs don't change with the level of activity, but now I'm telling you that there's a reason why it might. Because the insurance company might say, you know what, up until 25 million units, we feel that $100,000 is enough premium to cover our risk. But then once you start making 30 million units, 35 million units, the insurance company might say, there's a greater risk for us. A greater risk of, let's say, injury, or fire, or theft, or damage, whatever it is, whatever the casualty is that they're covering. So they might see that there's more liability, more exposure for them. So the fixed cost might actually increase. That's why the relevant range is important. Or if we're going to make now 30 million units, well, our rent might actually increase. Why? Because we might need a bigger facility. So we might keep the existing facility, but now maybe we have to rent additional warehouse space. So normally we think, well, we have this huge warehouse, that's a fixed cost. It doesn't matter if we make 1 million units, or 10 million units, or 15 million units, the cost for the warehouse is fixed. But, right, within that relevant range. But then once we make more than 25 million units, we're assuming, let's say in this example, then we're going to have to get more warehouse space to store inventory. So then in that case, our fixed costs are actually going to go up. So in this case, we're assuming that the cost of coffee to us Remember, we're talking about our cost, not what we're selling it for. We're assuming that it's going to cost us 22 cents within this relevant range. But we would like to think if we ever get to the point where we're making not 2,200 cups of coffee per week, but 22,000 cups of coffee per week, that we could get a better price. That our cost would actually go down. Questions about that? All right, so let's see, what is our total cost? So our total cost is fixed cost plus variable cost, which is what? So 1640. Yes. All right, great. Now, what we're going to do is we're going to calculate the average cost per cup. So what is the average cost for 2,000 cups of coffee? 82 cents. So what we do is we divide the $1,640 by 2,000 cups. That's 82 cents. Then we divide the $1,662 by 2,100 cups. How much is that? And then we divide the $1,684 by 2,200 cups. And how much is that?
76.5.
Do you round up?
Yeah, we could round up, say 77. Now, who could explain this? What's happening here? So, as the number of cups being served increases, so the level of activity increases, and what's happening? Abigail?
The cost per cup decreases?
Right, the cost per cup decreases. Does everybody see that?
Yes, the more we produce, the less it costs.
Absolutely. Now, why is that happening?
Because more produce.
Yes, we're producing more, but why? This is, I think, I want to make sure that we get this because this is a good illustration of what we've been talking about. Go ahead.
Activity increased.
Yes, the activity increased from 2,000 to 2,100 to 2,200, and so what is happening?
Because per cup, the fixed cost is not.
Close. What's happening to the fixed cost? We said the total fixed cost. Go ahead.
The fixed cost
Tatiana,
is,
right?
Yes. The fixed
Not to be
cost-
confused with Irina.
We look alike, I know. Fixed cost gets spread out over the bigger amount of cups.
Everybody got that? So isn't this what we said before? That the cost per cup is actually declining. Now look, the variable cost is actually increasing. Variable cost is going up from total variable cost from 440 to 462 to 484. But the cost per cup is actually going down because the fixed cost is being spread across more cups. So the more units that we produce, remember, we said the smaller the amount each unit or each cup is going to absorb.
Can you say that again?
Fixed costs are fixed, right? Fixed costs don't vary with the production quantity. Total fixed costs don't vary with the production quantity. So whether we make 1 unit or 1,000,000 units, our fixed costs are the same. But the unit fixed cost is the cost that each unit is going to absorb. Because what we actually want to figure out is the product cost. This is what we need to know. This is interesting to know that the total fixed cost is $1,200. Of course, we want to know that as managers. But ultimately, we want to get down to the unit cost, to the product cost. Why? Because if we don't know how much it costs us, how are we going to know how much to sell a cup of coffee for? So what we found out here, Abigail, is that as we sell more cups of coffee, the amount of fixed cost that each cup of coffee is going to absorb decreases. And that's what we're seeing here. That's why, although the total variable cost is increasing, the cost per cup is actually declining, because this $1,200 here is being spread across 2,000 units, 2,000 cups. Here, the $1,200 is being spread across 2,100 cups of coffee. And here, $1,200 is being spread across 2,200 cups of coffee. So the more units that we produce, generally the better, because of this concept of fixed cost absorption, which means that each unit has got to absorb an amount, a certain amount of the fixed cost. Remember, we said that we can't just look at the variable cost. When we figure out our cost for the product, we need to take into account the fixed cost as well as the variable cost. And so, the more cups of coffee that we sell, or the more units that we make, the smaller the amount, the smaller the dollar amount, each unit or each cup of coffee is going to absorb. Questions? Anybody want to paraphrase what I just said?
That's a question.
Damon, right?
Yes.
All right, go ahead.
Why does it say that the variable cost per cup is 22 cents in the question, but it increases so much for the average?
Okay, so what we're looking at here is the variable cost per unit is 22 cents. The total variable cost is 22 cents times the number of cups of coffee. That's what we calculated here. 440, 462, 484. So the total variable cost is increasing. So here it increased by $22. Why? Because we have 100 more cups of coffee here times 22 cents.
I mean, why is it so much of a difference between total variable cost and the average cost per cup?
Between the total variable cost,
No, like the 22 cents and the 82 cents or 79 cents.
Why is such a...
that's the fixed cost.
Yeah, how you determine how much will be fixed cost and how much will be variable cost per cup to come to this?
We're going to get to that.
It could be cost $5. Depends on how they make it. You could make it $5. If you don't like it, 82 cents for coffee.
That's,
$10.
yes.
You know what?
That's what we're going to talk
Just
about.
whatever you like. Just pay.
We're going to get to that. Yes, we're going to get to that. All right, let's look at another example. Yeah, this is a very good point. I'm going to go over an example with you. All right, let's look at problem number 3. All right, problem number 3 is an example of the high-low method. Everybody's got this?
Professor Bassell, I'd like to ask you, can you look before exam 1 on the quiz which you already took it? Just can you open it and look at it? What problem was, how the problem was resolved of that?
You want to be able to open your quiz?
Yes, and look at them, like, you know, to read it again.
You're not able to. You're not able to view your quiz.
I'm not able to do what?
You're not able to see your quiz.
I'm not why.
That's the way the system is set up.
What system is it about? Who made it then? We need to open door, not close it.
No option. It's an option. But right now it's not set up that way.
People make it option by themselves.
All right, let's see. What's going on here in problem 3? All right, there's this hotel in Big Sky, Montana. And what they have here in this chart is the electrical cost of the hotel for a given month and the number of occupancy days over the year. And here they tell us that the occupancy day represents a room rented out for 1 day. They tell us that the business is very seasonal because people come there to ski, and mostly in the summer. Right, you see that? Everybody's looking at the chart where it has January, February, March. You see 1,700 days, 1,900 days, 2,300 days. And then April, May, and June, it drops very dramatically. So in April, it's not even 1,000 occupancy days. In May, it drops to 360. In June, it goes up. Actually, in June, it goes up quite a bit from May to 744. And then very busy during July and August, 2,100, 2,400, and then it drops dramatically again in September. October is very slow, November is slow, and then it starts to increase again in December. So what we're trying to figure out here is how much is the cost of electricity? So what we're trying to do is estimate the fixed cost of electricity per month and the variable cost of electricity per occupancy day. So do you see the challenge here in managing this business? Based on this data, what's the issue here? If you're going to run this business, what's our concern? Remember, we're concerned about costs and cost behavior.
The usage of electricity.
What was that?
I said the usage of the electricity on months.
Absolutely. So in some months, we're using a lot more electricity than others. Now, if we're going to manage this business effectively, and if we're going to manage our cash and be able to pay our bills, we need to be able to get a handle on this. So what are we talking about here? We're talking about cost behavior. How is the cost going to respond to changes in the level of activity? Isn't that what we just looked at with the coffee example? That's cost behavior. That means we saw as the number of cups of coffee being sold increased, our total variable cost increased, and our average cup of coffee, the cost decreased. So now this business is very seasonal, which is very problematic for us. That's a challenge for us as managers. We're thinking every month we're going to get, our electric bill is going to be different. And a business is going to have a bank account, and they need to make sure that they have enough money in there to pay the expenses. and pay it on time,
Exactly.
right? Now look at all these, the variability in the electric bills for this business. But what do these managers suspect? What they suspect is that there's a relationship between the cost of electricity, so in other words, the amount of the electric bill, and the number of days that the hotel is occupied. So what that means is that there's a relationship between the level of activity. In this case, it's the number of occupancy days. In this case, it was the number of cups of coffee. In another case, it could be the number of glasses of orange juice. So let's try and see if we can figure this out. So for budgeting purposes, what we're going to use is this method called the high-low method. So what we're going to do is we're going to look at which month has the highest level of activity and the highest electric bill.
August.
Yes, August. 2,406 occupancy days. Try saying that 3 times fast. And the electrical cost is what? Exactly, $5,148. That's the highest electric bill all year. And then, which month is the electric bill the lowest? Right, October is 1588. All right, so let's document that. All right, this is the high-low method. So you take the highest activity level, in this case we said is August, and the lowest level of activity, which we said is what, October? All right, the number of days for August is what? Right, 2,406, and for October? Yeah, it's a very big difference. And then the electric cost for August, yeah, 5,148. And for October, could you imagine if you got an electric bill at your house for $5,000? What would you do?
Need to pay. This is business, you need to accept this thing before.
All right, so what we're going to find out, what we're going to calculate now is the difference between the two. So the difference between the high and the low. And the difference here is 2,282. And here the difference is $3,560. All right. Are you ready?
I was thinking, why do we need to minus? Why? Why do we need to from high?
No, I was talking to Irina. Oh, and I'm gonna.
Because you always talk to me, because I was thinking.
I know, always, of course. You You should sit here. Well, how come you always sit back there?
My bag is there.
Oh, okay. You have a seat for your bag too?
Exactly.
One for you and one for your bag? Okay. All right. So what we want to figure out is the change, because what we're going to do now is we're going to address Irina's question about how much is variable cost and how much is fixed. So I'm going to show you how to calculate that. That's why we need to calculate the change, because the variable cost is equal to the change in cost divided by the change in activity. Are we good?
Great.
Oh, we're great! Wow! I'm going to stop right there. That's it. All right. So the change in cost we calculated as 3,560. And the change in the level of activity, in this case is, for this business, is the days, the occupancy days, which we said is 2,282 days. And that gives us,
156.
right, $1.56 per day, per occupancy day. Now, there's a reason why we did this. Because what we're trying to figure out, remember with the previous examples, is, well, what happens if the activity level is 2,800 days, or 3,800 days, or 4,800 days? Or what if it's 80 days? That's why we keep going back down to the unit level, because we want to be able, as managers, to do some analysis. We're going to have to do some forecasting. Remember, we're talking about using this data to make decisions about the future so that we could plan. So maybe we need to add on to the hotel. Maybe we need more rooms. Remember we said we're not going back and looking at the past performance. What we're trying to do is figure out, well, how do we plan for the future? Maybe we need to add on an extension, just like they did to Ingersoll. Maybe we need to add on to this Big Sky Mountain Cayenne resort. So that's why we're going through this. So now, we found out that our total cost for August is $5,148. And the variable cost component, right, this is what you were asking, right, Irina? The variable cost component is what? Is $5,148 which equates to 2,406 days. So what we do is we multiply the 2,406 days times $1.56 to get, how much is it? 3,753. So 2,406 days times $1.56 gives us 3,753. And what we do is, remember, this is variable. This is the variable cost. That's what we just calculated. The total cost is $5,148. Remember, the total cost is variable cost plus fixed cost. So $5,148 is the total cost. Now, if we subtract from that the variable cost, that's going to give us the fixed cost, which in this case is $13.95. That's the fixed cost.
I'm just looking there. It's not this one, 375.
So this is known as the high-low method. So in order to calculate the variable cost, we need to, like Elena was saying, yes, go ahead, Krista.
I have a question. How did you get the total cost? Which two did you use?
The total cost is the total electric cost for August.
Not October as well?
No. So remember, what we did was, because Krista, what we did was we looked at, we have 12 months here, and you see the electric bill is different every month. So we said, well, how do we get a handle on this? This is crazy. So we said, wait a minute, let's try this approach. Let's look at the highest activity level and the lowest activity level.
Well, I understood all of that, but you're just going to take that as the total cost because it was the highest?
Right.
Yeah. Okay.
So that's like the worst case scenario so far, based on what we have, what we know in this this business. Now we might predict that we're gonna get some positive publicity, or maybe we're gonna start advertising, and the occupancy days are gonna increase, so our electric costs are gonna increase. That's what we're trying to figure out. What we're trying to do as managers, as managerial accountants, is figure out how much is the electric bill going to be next month. That's the challenge for us in managing this business. Do you think it's worthwhile? I mean, is that something that we need to know?
It could be fixed cost, plus it depends how many people do you have. Anyway, we need to pay for electricity, right? Plus it depends if you have 100 or 300 people, it's differences people will have. Plus depends how many people you have. It will mix cost.
Right, absolutely. So we're trying to forecast that. We want to know in a month from now, in 2 months from now, in 6 months from now, what is the electric bill going to be? So we have to make some assumptions. So if we're assuming that the number of occupancy days are going to increase, because ideally, we don't want to have seasonality in our revenue. In fact, most companies would prefer what's called a smooth revenue stream. So basically, you're going to see the same level of sales every month. That makes it a lot easier to manage a business. In many cases, that's not the situation. Think about, for example, department stores. Department stores, their business is very seasonal. A very significant percentage of their sales is done in the fourth quarter because there's a lot of holiday shopping. So at the beginning of the year, it's very common in January, February, March that the business is not profitable, that they actually have to borrow money to cover their expenses for the period because their revenues minus their expenses does not provide a profit. So in order to cover their expenses, in order to pay their electric bill, they need to borrow the money. Because think about it, Macy's, for example. They're open 24 hours. They never shut off the electric there. Now, they're not open to the public 24 hours, but when they're closed to the public, they have people there doing floor moves and restocking and maintenance, things that are difficult to do when customers are there. So the lights are on all the time. Well, in some months, they're not doing a lot of sales. Usually at the beginning of the year, they're not doing a lot of sales. A lot of the sales are done in October, November, December. So their business is very seasonal. Other companies also have seasonal businesses, but they try to combine businesses that have alternate seasonal patterns. So what does that mean? Like right here in Brooklyn, near King's Plaza, there's a place on Mill Avenue. What do? In the back half of the year, they sell Christmas trees, and the first half of the year, they sell swimming pools. Really? Now why? Because they understand this. They're like, what are we gonna, people aren't gonna buy swimming pools in November, December. But say, what are we gonna do? We'll stand there all day long, we'll have the lights, I'm gonna pay Miss Clemenco, I'm gonna pay Barry, I'm gonna pay Caroline, Zev. Well, I mean, how are we gonna make money here? So I said, it was a good idea to take that course with Coach. I got it. What we're going to do is we're going to smooth our revenue stream. So we'll sell swimming pools this half of the year, and the rest of the year we're going to sell Christmas trees and Christmas ornaments and so forth. I think they even sell Hanukkah bushes there too. So something for everybody. I don't know if they do Halloween, but you know, they have some stores that have space, and they do Halloween, then they change everything. Well, like even in some stores, they do that. They have like a seasonal section that they keep rotating out for every holiday. First it's Halloween, and then it's Valentine's Day, then it's, you know, they have something in that section that they're changing all the time. But there's some shops, actually, they have some Halloween stores that are like open all year round. So, you know, this year this is going to be our 5th annual Halloween party at the Student Center across the street there. But, you know, you're not required to come. Last year we had 1,000 students that attended from Brooklyn College. Last year I was a gorilla. So there may be reasons why you might want to come. The year before that, I was Spider-Man. One year, I was Superman. Could you imagine me in a Spider-Man costume? Is that crazy? It must have been a Spider-Man costume with cufflinks, I hope, right? At least. So it's fun. It really is a lot of fun. You know, I know everybody's busy. I mean, there's no pressure. Really, a lot of students come and they put on all these very elaborate costumes and makeup and everything. It's really a lot of fun. So I know a lot of you work, but you know, it's a good opportunity to get involved and have some fun. So that after you graduate, you could look back and you say, you know, I went to this party. Right across the street in that building. And that's going to be on, let me just double check, I believe it's October 28th.
Yeah, got it.
Yeah, Friday, October 28th. From 8 p.m. to 2 a.m. All right, let's keep going here. Fun times. I don't know. I don't have a costume for this year. I don't know. I don't know what I'm gonna do. Ideas? Anybody got ideas? Because I'm like so fresh
My
out of
daughter, I
ideas.
remember, spent $78 for costume. You know, something like
Maybe
that.
I could go like this. People think this is my costume.
No, it's not working.
No? It's not working? Alright, we'll have to think of something. I don't know. Nothing? Nobody has any ideas? Somebody, last year somebody came, a girl came there as, from Avatar. She had this blue makeup all over her body and everything.
Wow.
Literally all over her body. Because that was like her costume. So I'll leave the rest to your imagination. Right? You were this, right? That was pretty much, that was it. That was interesting. But, all right, so number 4. Let's see. All right, so let's look at this alpine house. Interesting. This is interesting stuff, right? I'm learning a lot.
The most interesting only take the keys at home. It's most interesting. Because you have short time there. When you, I said the most interesting when you take the quiz at home. Time limited.
90 minutes.
Yeah. 90 minutes. That's all.
What happened? What, you fell asleep at the computer?
Exactly. Right?
All right, let's look at this on page 229. All right, let's see. The Alpine House, a large retailer of winter sports equipment. An income statement for the company's ski department for recent quarter is presented below. Skis sell on the average for $750 per pair. Anybody here go skiing? You do? Oh, cool. Variable, all right, now see what we're talking about here. They said $750 is the selling price. Now we're going to go back and we're going to talk about costs. The variable selling expenses are $50 per pair of skis sold. The remaining selling expenses are fixed. Because remember we said total costs are a combination of variable cost and fixed cost. The administrative expenses are 20% variable and 80% fixed. How do we classify administrative expenses? Somebody.
Supervisor.
No.
It's a non-manufacturing cost, which is also known as,
Period.
right, a period cost. So there's product cost and period cost. Product costs are the manufacturing cost. The period costs are non-manufacturing costs, also known as selling, general, and administrative. So what they're telling us here is that the administrative expenses, these period costs, that some of them are variable and some of them are fixed. The company does not manufacture its own skis. It purchases them from a supplier for $450 per pair. So what we have to do is prepare the income statement using the contribution format for the quarter. All right, so let's see if we can do this. We can do it. Yes, we can. No, huh? Yes. If you can't do it, I'll help you. All right, so we're going to do an income statement. Remember, we've done income statements before, but this is a little bit different. Alpine house. So they tell us our sales. Sales are, somebody? Anybody? So if sales are $150,000, how many sets of skis, how many pairs of skis did we sell? How do we figure that out?
Total, 550 by 750, 150,000 by 750.
Right, so $150,000 divided by $750, which is the price. Remember, here we're dealing with both price and also cost. So we know that they tell us sales are $150,000. They tell us that each set of skis is sold for $750. So David says that means that it's 200 sets, 200 pairs that were sold. All right, so now we're going to look at the variable expenses. So we're going to look at the cost of goods sold. Which they tell us is what? Right. So what we're trying to figure out is, what is the cost? We know that this is $750 times 200. So this is if you want, we can look at it this way. 200 pairs times $750 is $150,000. And 200 pairs times, who said 450? Who? You? You? Good, Crystal. So, Crystal, tell us where you got the 450 from.
Where they purchased? Because.
So, it's a retail organization. We have to buy inventory, where they say we're not manufacturing it ourselves. So, the $450 is the cost. That's the cost of goods sold. So 200 pairs times 450. So that means for each pair that we sell, we have what? $300 is the unit contribution margin. All right, so how much is this? $90,000 is the cost of goods sold. But we also have some selling expenses here. Which is what? Remember, they tell us this is on a variable basis, right? So we need to, the way that we calculate that is the number of units times the variable cost per unit. Just like with the coffee, it was 22 cents per cup. In this case, the selling expenses is how much? $50 per pair, which is selling expenses of $10,000. And we also have administrative expenses. In this case, they broke it out for us. Very often, we just see this as SG&A, selling, general, and administrative. Now, these are, they tell us, what do they tell us? The administrative expenses are what? They tell us that 20% are variable. So it's 20% of the $10,000. So they tell us that the administrative expenses, 20% are variable, 80% are fixed. $2,000.
Let's move this back over here.
So the variable expenses are $102,000. So we subtract the variable expenses from the sales to get our contribution margin, which is $48,000. Now we have to, yes, we have to deal with our fixed expenses. Go ahead.
I'm very confused. Why did we skip the 30,000? I mean, that's what is in the book, in my
Selling expenses.
selling expenses 30,000 and then administrative expenses 10,000.
That's a fixed expense. That's what we're going to address now. So we looked at our variable expenses. Now we're going to look at our fixed.
Okay.
All right. So you're going to help us with the fixed because you're right. There's some other expenses, but remember we want to understand what costs are fixed, what costs are variable. All right, so Tatiana, tell us what you were just explaining to us.
8,000 administrative expenses.
All right, so we have the selling and we also have the administrative. Remember, they tell us it's 80-20. So in this case, the administrative expenses, the fixed portion is 80%. Which is 8,000, right? Is that what you got, Tatiana?
Yep.
All right. Then what about the selling expenses? You told us, so you mentioned the 30,000. So what do we do with that?
Multiply by 20%? No, 80%. All the fixed elements, 80%.
Well, we got to do a calculation there because we have 200 pairs times $50. Because remember, they tell us that the variable expense is $50. So what we have to do is subtract from the total selling expense the variable expense to get the fixed cost. So we have fixed cost plus variable cost equals total cost. So what did they tell us the total costs are? The total selling expenses. Go ahead, Tatiana. They told us a total cost of 30,000. The total
30,000, yes.
30,000.
So if administrative expenses 20%, then we should take
Minus-
Well, look.
20% of
Sure. Let me
30,000.
see if you. Let's use this formula. Fixed cost plus variable cost equals total cost. So we have to back into this. They tell us that the total selling cost is 30,000.
So,
But part is fixed and part is variable. So what percentage of the administrative cost, for example, is fixed? What do they tell us?
20%.
20.
All right, you're saying 20, she's saying 80. So which one is it?
Fixed
I thought it was
80,
80%.
variable 20.
So for the administrative cost, it's 80%.
It's like that.
So if 80% is fixed, then 20% has got to be variable. That's why we figured out, that's how we did this here. They tell us the 10,000. They tell us that the administrative expenses are $10,000. But we want to, look, we want to know, right? Isn't this this was your question? Right, Irina? Not to be confused with Tatiana, right? This was your question. He said, well, how do you know what part is fixed and what part is variable? And I said, okay. So now we're looking at another example that addresses your question again. They tell us that the administrative expenses are $10,000. But, like Irina said, what percent of that variable is, of that cost is variable? What percentage is fixed? They tell us, in this situation, they tell us it's 20%. So the variable administrative expense is $2,000. Here, again, we know that our total administrative expense is $10,000. They tell us that 80% is fixed. So that's how we get 8,000. Now, selling expenses. What do they tell us? They tell us that the total selling expenses are $30,000.
Minus 10,000, will be 20,000.
No, why minus?
So if the total selling expenses are $30,000,
We fix
what do we know? What do we already calculate the variable selling expenses are? 10,000. The variable selling expenses are 10,000. Total selling expenses
20,000.
are 30,000.
20.
That means that the fixed cost is 20,000, right?
Professor Bassell, I'd like to ask you,
Yes, Ms. Flamenco?
yes, I'm here. I would like to ask you, why when we wrote selling expenses and we wrote exactly 20, what give you point to wrote that 20, 200?
200 is how many sets of skis we sold. 200 pairs of skis. So,
But which solution get in book? How do you figure out what you need to exactly use this one? I could not see this is the book. How it's told.
all right, they tell us, remember, they don't tell us the 200, that's the calculation that we did, right? Because we said $150,000 was our total sales for the quarter, and they tell us that each pair was sold for $750. So if each pair is sold for $750, that means that we sold how many pairs? 200. See, they don't give us the 200. That's another way. They might have given us just the 200, and then we'd have to figure out 200 times 750. But remember, that's how we calculated this. So at the beginning, we said 150 was our total sales, and then each pair of skis we sold for $750. So that means that we sold 200 pairs of skis. So you're right, that information was missing, we needed to calculate that.
And why did
All
we
right,
get
is
the
everything commercial now?
Everything goes wrong.
Good.
The 60.
50. How did we get the 50? They give us 50. Yeah, they sell us they say the variable selling expenses are $50 per pair of skis sold. That's in the, all right? Now, but we're not done yet. I mean, we're not done yet. I mean, like, class is not over. All right, well, we're not done with this problem yet either. All right, so fixed expenses are $28,000. And what do we get here? 48,000. So we have let's bring this up here. Sales, 150,000. A contribution margin. Well, we can do it this way. Let's do it this way. Minus our variable is 48,000. Minus our fixed. It's 28,000. Our variable is 102,000, right?
Yeah.
Our variable is 102,000. That would have been a nice business to have there for a second, but I know it's still going to be true. So our variable expenses are 102, fixed are 128, so that leaves us with how much?
20,000.
So our net operating income is 20,000. Questions? Everybody's got it?
Do you always have to do like when you're doing the contribution format income statement? Do you always have to do the variable expenses first and then fix? Is it better to do it that way?
Yeah. Yeah, you should first do the variable expenses and then the fixed. And keep in mind, like we had pointed out, there's some information that's going to be missing. We need to calculate that. In this case, we're missing part of this equation. And we were also missing the number of units that were sold. So if you have variable costs, if they tell you the 22 cents per cup, for example, then you need to know, the only way that's relevant to us is if you know how many cups that you sold, because we're trying to figure out the total cost. So in this case, they told us that the cost per set of skis was $450. The selling expenses were $50 per pair. And there could be some other variable expenses per unit, right? So as the level of activity increases, either the number of units sold or the number of units produced, then our cost is going to increase. Then we need to know the number of units, which in this case they didn't tell us. So we have to figure that out.
So now our total cost is 130,000.
Yes, 130,000. Now remember, we're looking at this a little bit differently than we did in the past. Because now we're trying to understand what's happening, and I kind of gave you a little bit of a foreshadowing to this when I kept telling you, well, what happens if it's 48,000 units? Remember a couple of classes ago. What happens if it's 58,000 units? What happens if it's 68,000 units? If it's 78,000 units? Like, this is different. This approach is different than when we prepare the cost of goods, the schedule of cost of goods manufactured. There we were focusing on the product cost and trying to establish a total manufacturing cost. Remember I said we want to know what if. That's what we're trying to solve for. What if? So in order for us to solve for what if, we need to understand cost behavior, which means how are the costs going to change when the level of activity changes. And we said within a relevant range, some costs won't change. Those are the fixed costs. But the variable costs are going to change. And in order for us to budget, in order for us to plan, we need to know what impact an increase in the level of activity is going to have on the profitability of the business. So we can't wait. We can't wait and see. Let's say, okay, we sold 225 units this month. We need to do some analysis and say, well, what if we do have a sale? What about if we lower the price? Let's say we lower the price 20% and sell the skis now for $600. We might be able to do that because look, we're buying it for $450, we're selling it for $750, so we're reducing our profits by $150 per pair. We may want to do that. But we need to understand what's going to happen to our variable costs.
Because you need to pay our bills.
Right, exactly.
You need to make some money.
We have to pay the accountants, right?
Yes, you need to pay for the electricity which will come.
Exactly. So now we have Crystal is our store manager. And you're our accountant, right? What do you think? Ms. Clemenco
Yes.
will be our accountant, and Crystal is going to be our store manager. We have to pay them. But so we need to go through this analysis and figure out, well, what if we do run a sale? And that's what companies do when they, retail organizations, when they have sales. Of course, they understand that in an elastic market, that when the price goes down, what happens to demand? Demand is going to go up. So elastic, it means price sensitive. So conversely, when the price goes up, that means demand is going to go down in an elastic market. So for many consumer goods, the market is generally quite elastic and sensitive to changes in price. So we need to determine, we need to be thinking ahead. Should we lower the price 10%? Should we lower the price 15%? Well, we need to do that analysis and understand what's going to happen to our costs and what's going to happen to our sales. So will our total revenue be greater? Our total revenue. That means that even though we're going to be selling them at $600 instead of $750, instead of selling 200, maybe we're going to sell 500 pairs. So even though we're selling them at a lower price, we're selling more units. Ideally, that's what we want to happen, is our total revenue to increase. Sometimes it doesn't always happen that way, and that's a problem. Sometimes we lower the price, and that's not necessarily something that we could influence, because, for example, when the economy is in a recession, so the market is not going to respond the same to price changes. So you lower the price to $600, and you know what? People say, you know, I'm going to wait to get a pair of skis. Let me see if I have a job next week. I have skis. Yeah, it's $600, but you know what? Instead of trying to save $150, I could save $600 if I don't buy the skis.
But they still need to pay electricity and rent.
Right.
What can gonna do?
Right, electricity. Yeah, so electricity could be a big
Exactly.
monthly expense.
$24 hours a day, it's a huge bill.
Right. You're right. Absolutely. So we need to go through this analysis. Questions? What do you think? Is this realistic? Do you think this is how, let's say, department stores make decisions?
Yes. Because I always think, do we have enough money to go down, or should we wait? If you will go down, this is our price, how much you will make it? Because you need to pay back $450 for those shoes or what it earns.
The
You
skis,
need
right?
to pay fixed cost, variable cost, and at the end, do we have any net?
Exactly. Is there going to be any net operating income?
Because in present time, we have only 20,000. If the price is going down, how much you will be put there?
Absolutely. Everybody get that? So that means, basically, what you just said is, will our total revenue increase? Because what happens, right now we have $150,000 in sales. If we lower the price by 20% to $600, that means if we sell the same number of units, our sales are only going to be $120,000. If our sales are only $120,000, what did you tell me before? How much is
Then
this?
we have income minus 10. What we gonna do?
Right.
What we gonna do? We need to
Right.
go to bank
We might have to
to
fire
ask for
Crystal.
money. To borrow some money.
Right, right.
If you did not borrow the money, you need to follow the business. Because you need to pay the salary. We're going to work for free.
Yeah, exactly. You might have to work for free. What do you think, Crystal? You work for free?
No, big one family.
No, she's not feeling that. So if we sell the same number of units and sales are only $120,000, then we're not going to be profitable. In fact, we're going to lose $10,000. So we need to make sure that, our goal is that our total revenue is going to increase. So that's not something that we could leave to chance. That's something that we need to calculate and go through some analysis. All right, for homework, I want you to do exercise 5. And exercise 7.
So 5, 5, and 5, 7?
Right. Yes. Now for, let me tell you, for 5, 7, let me give you this, write this down. This is the answer to part 2 of that question. We'll see why this is going to be significant. Can anybody tell me what they think this is? What is this, in view of what we just discussed? What is that? What do you think that is? What is that going to tell us?
It's going to tell you the total.
Yes, I heard somebody say something.
It's equal to fixed cost. Number of units.
The number of units, go ahead, Elena.
It's price per unit multiplied by number of units, X number of units.
And so,
Is that 74?
yeah, 74 cents. Oh, sorry, yeah, this is 74 cents. So what this tells us is this is the model that we're going to use to calculate y in this case is the total cost. So this is the fixed cost for this example for 5.7 is $4,200. And then the variable cost is 74 cents times X, which is the number of units. So for us, the reason why this is helpful and why we go through this with the skis and the coffee is because ultimately what we want to do is get an equation like this so that we could determine at a given level of activity, X, what is our total cost going to be? That's what we're trying to figure out. This is total cost. This is fixed cost. So the fixed cost here is $4,200. The variable cost is 74 cents. And then you multiply the 74 cents times the level of activity, which could be the number of units produced, the number of cups of coffee, the number of skis that are sold. Well, what we need to know is the level of activity. So this equation is going to tell us the total cost. So whatever level of activity you put in there is going to be able to tell us our total cost. So whether it's 1,000 units or 2,000 units or 5,000 units or 10,000 units or 10 million units, then we multiply the number of units times 74 cents, which is the variable cost. With the coffee, it was 22 cents. Here, the fixed cost is 4,200. We add the 4,200 to the variable cost, and that gives us our total cost. All right, let's go over the homework column. The weighted average is 411, right? We're going to take a 5-minute break? No? Okay, good. You good? All right, let's go. Let's get this thing done. All right, 411. Who wants to read the problem?
Super microproducts uses the weighted average method in its process costing system. During January, the Delta Assembly Department completed its processing of 25,000 units and transferred them to its next departments. The cost of beginning inventory and the cost added during January amounted to $599,780. Ending inventory in January consisted of 3,000 units, which were 80% complete with respect to materials and 60% complete with respect to labor and overhead. The cost per equivalent unit for the month were as follows. Cost per unit, materials $12.50, labor was $3.20, overhead $6.40. You be required to
All right, go ahead.
compute the equivalent units of materials, labor, and overhead in the ending inventory for the month. 2, compute the cost of ending inventory and of the units transferred to the next department for January. Number 3, prepare a cost reconciliation for January. Note, you will not be able to break the cost to be accounted for into the cost of beginning inventory and cost added during the month.
All right, good. All right, so what we're going to do is we're going to use the weighted average method to get the answer. Now the first part, Damon told us we need to compute the equivalent units of materials, labor, and overhead in the ending inventory for the month. Why do we need to do that? Who remembers? What is this thing with equivalent units? Remember you had asked that last time. What is it? What is this about equivalent units? What equivalent units? We know how many we produced, right? How many we made in a given period. What is the equivalent units? What is that about? Why do we need to look at the equivalent units? Why is there equivalent units? What is it that's...
The units that you didn't sell?
Yeah, go ahead.
That you produced but you didn't sell, because you didn't complete.
Right. So there's units, remember, and they tell us here that at the end of the period, there's still some units that, so the ending inventory in January consisted of 3,000 units, which were 80% complete. So we have some work in process, and we have to continue to adjust for that, just like when we did the schedule of cost of goods manufactured. We need to take that into account. When we figure out remember, because ultimately we're going to use the schedule of cost of goods manufactured to calculate the cost of goods sold. That's an important line item on the income statement. From our sales, we subtract our cost of goods sold. In many companies, the cost of goods sold, for manufacturing companies in particular, the cost of goods sold, and for also retail organizations, the cost of goods sold is a significant percentage of the sales. So for example, if you have, let's say, $100 million in sales, then the cost of goods sold might be 60% of sales, might be $60 million. And then we subtract the selling, general, and administrative. And we need to know where the costs are being generated so that we can try to make some adjustments. So we need to know, is it because our electric bill is too high? Or is it because we're spending too much money for plastic from Turkey? That's what we need to try and understand. So, product cost and period cost. Then once we make that distinction, once we make that classification, then we're in a position to implement a cost reduction process. But we know where to focus. Maybe we have too many accountants working for the firm.
You lay all of them.
Lay them all off, right?
Nobody-
Too many accountants. We have too many accountants, we need more salespeople. But we need, in order to be able to make that decision, we need to have the facts. So we need to know, are the course product course or are they period course?
I think some question about from PS4, right? Like, I remember it was some kind of issue, like we sold 5,000 and I really complicated, I still could not get this thing. I still couldn't get away from this, you know what?
That was when you fell asleep?
It's something just, it does.
All right, so let's see if this example is going to address that problem. Was it similar to 411?
It's not the same.
It's not the same?
It's very different from that what we are having in class and what I read in the book and what I have on my quiz. This is,
Really? Wow.
I don't know, it looks like for me it was. Maybe I was wrong.
All right, we'll see. So the equivalent units, you need to take into account that there are some partially completed units. Right? So maybe it's those, remember last time I showed you the evil eye? You remember? Okay, the blue stone that's going to repel negative energy. What about if you have those, but they don't have the eye on it? How many, right?
It doesn't change anything.
How many of those are you going to sell? If it doesn't have the eye, then it's not an evil eye. So partially completed. And remember we said that it's not uncommon to have partially completed goods. Sometimes that's a strategy to produce partially completed goods, and then why? Why do we do that? Why would you say it makes sense for it not to be an accident? Why would you produce 10 million evil eyes without the evil eye on it? Why would you not do that?
It's too much money. It's gonna be wasted.
Yes, Olana, tell us. What is too much money?
Well, it's like wasted money because if you produce something that is not supposed to look the way it looks, then nobody's gonna want it, and it's just waste of money.
So, but why would we produce 10 million of them without the evil eye? Why would we wait until we get the order from Walmart in Turkey?
It would not. You'd have to check.
You'd have to check,
Yeah.
Because you do not get the order.
and because what happens if you don't get the order?
Wasted the whole cost of the whole item instead of just a partial cost.
Exactly. So what Damon is saying is, we have partially completed goods. That means partially completed cost as well, right? We only have the cost of manufacturing the stone itself, but we didn't incur the labor cost to hand paint the evil eye on the stone. So if we don't get the order, then we saved millions of dollars in direct labor costs. Now hopefully we could use that stone and to paint like a picture of Dora the Explorer or somebody, SpongeBob, or something else that we could use to sell. But that's the reason companies will produce partially completed goods, because this way they don't have to invest, for example, in the direct labor cost or the packaging cost. What if, for example, then we had to take it after we incurred all that labor, then we had to put it into a box. We have to pay laborers to package it, and we also have to pay the cost of the packaging. So it makes sense. Let's wait and see. Let's produce 10 million units first, and then as we get the orders, then we could make to order. It doesn't need to be make to stock. So make the units first, then afterwards we could customize the stone as necessary. So we don't want to tie up all our working capital. We don't want to tie up all our cash in paying workers to paint the evil eye on there. And then maybe we're not going to sell those for 6 months or 10 months or 12 months. And we already paid the supplier for the corrugated packaging. And we already paid laborers to put the stone inside the packaging. So that's a significant amount of cost. What we could do is defer some of those expenses. And so when that happens, we have these inventoriable costs, but we're not going to expense them until the product is actually sold. That doesn't mean that we didn't have to pay for them. We did, so that's the reason why we might wait, why we might actually have partially completed goods on purpose. Although you might think it a little strange to have some teddy bears that don't have arms, maybe that's a significant cost that's maybe very labor intensive for the organization. All right, so the first part, this is very straightforward. What we're going to do, like we've done before, is compute the equivalent units. All right, and Damon told us that the units in ending inventory were 3,000. And remember, the three components that we look at are the materials, the direct labor, and the overhead. So 3,000. So that's what we're told. We're told it's 3,000. Right, Damon, that's what it tells us for this company? And what about the percent complete?
80.
All right, so it's 80% materials, 60 and 60. Everybody know Mo?
Yeah.
Okay, good. All right, so now what we do is we calculate the equivalent units. $2,400 units. Remember, this is units. We're not talking about the dollars yet. We're going to get to that. 1,800 and 1,800 units. All right, so that's the equivalent units of production. Now, what's the second part? Tell us there. Remind us. What's the second part we're going to do now?
The cost of ending transfer to the next account.
The cost of the ending inventory. The ending work in process. Right. So we're going to calculate the cost of the ending work in process. And units transferred out. So it's not enough to know the number of units that are partially completed. We have to know the value. We want to find out what is the value of the partially completed items. All right, so we did the first step. We know the equivalent units. Now we're going to calculate the value of the work in process at the end of the period. So we just bring down the equivalent units into this part of the problem.
Excuse me, is that, what is the numbers you just got, or is the VAP annual? Because the last time we did, we add 25,000 to each of them, and then we'll get a number.
Right, we're gonna do the, we're gonna look at the units transferred out as well.
Oh, that's the second question.
Yeah, that's part of the second question.
No, I think we
But
did
the way we did it
one.
before, it was like all in one.
Oh, I see what you're saying. Yeah, you could do that. You could do that. Just, multiply, you're saying 27,400?
Yeah.
You could do that.
So what's called equivalent units then? All of them? Or the last?
No, the units transferred out are those that are completed.
Okay.
Right, so the equivalent units are those that are partially completed. But the cost per equivalent unit is going to be the same for the units transferred out as well as the equivalent units. Yeah, that's why I think for now it makes sense to look at this one by looking at them separate. So the cost per equivalent unit is what, $12.50 for materials? $320,
And 640.
$640. All right, so the cost of ending work in process. Right, 5,760. So the total cost, right, the total cost accounted for, Elena, the total cost accounted for is going to be the same, but here this is the cost of the work in process at the end of the period, and the 25,000 is what we're going to look at is the cost of the units transferred out, which we're going to add those together. You're right, but we need to first understand what is the cost of the WIP. All right, so let's look at the units transferred out, which in this case is 25,000. And that gives us what? What is the cost of the units completed and transferred out?
It's 1250. It's 1250, that's 320 and 640.
Good, wow, somebody's paying attention. I did that to see if you were following. All right, so how much is it?
312.
312, 500.
80,000 and 160,000.
I smell apples. Who's eating apples in here? The other night I saw you eating apples. How many did you eat?
How many? Many.
At the beginning of class, you were eating an apple. At the end of class, you were eating an apple during break.
Exactly. You know what? It's true.
How come?
Because it's healthy, right now.
Oh,
It's
okay,
better
that's
than donuts.
Good, that's good. You're right. Next time I'll bring you guys apples.
Because you need to be healthy, isn't it, Professor Bassell?
Right, you're right.
If it's not healthy food, you don't feel good, you will be asleep.
Right, you're right. That's a good idea. I'm gonna put it on myself.
Do not eat bagels or donuts and
All right. So, did everybody get Elena's point here? So we have the value of the work in process at the end of the period, which in this case is 47,280. And the value of the course of units completed and transferred out, which is basically what? What is that really? Finished goods.
sold cover.
Finished goods. No, we're not up to sold yet. Don't get ahead of yourself.
But this may be complicated.
Finished goods. Doesn't mean that we sold it. We just want to find out the value of the inventory, the work in process and the finished goods. Course of units completed and transferred out. So we have, that's 552,500. And then you add them together. But you see why you need to add them together after, right? It's better to do it this way so that you know the value of your WIP and the value of your finished goods. Because if they're together, then but we don't know what we have. We don't know how many partially completed teddy bears we have. Well, the value of them rather. And this is what we call
559.
how much?
5,000. 599.
Right. So this is the total course to be accounted for, which is the 599,780.
And 780.
780.
Professor, if we sold right now, where will be sold? If we sold some.
Yeah, if we sold them,
Okay, we sold some. We sold 20,000. Where it is? Where we can put this thing here?
then what we have to do is we have to make journal entries when we transfer raw materials to work in process, from work in process to finished goods, and from finished goods to cost of goods sold.
Can you
Down?
put this on the board?
Yes, we could do that, but let's finish this first. But you see what I'm saying? That we have a certain amount, because the course is inventoriable, we have a certain course. The first course is we buy the plastic. So we buy the plastic, and then, remember we said there's conversion course. We convert the plastic into WIP. So once we know these numbers, then what we have to do is the journal entries that show that the raw materials were converted to work in process, a certain value, if not units, right? And when we make the journal entry, it's not units that we're talking about, we're talking about a value of inventory. Then that value of work in process, whatever it is completed. It becomes finished goods, inventory. Because remember, we said we have different types of inventory. We have what? Raw materials. We have WIP. We have finished goods. So we're gonna, those are, what types of accounts are those? Those are assets, right? Those are asset accounts. But we're interested, remember we're talking a lot about how we classify the course and the inventory. So we want to know at any given time, we need to know what is the value of raw materials. what is the value of WIP? Because remember, on our balance sheet, that's an asset. But when raw materials, remember we had that example, we said when we take the plastic out of the storehouse, remember we said we have to use that requisition form. The reason we do that is because we want to know now that the raw materials is no longer raw materials. We use those raw materials and converted them to WIP. And then at some point, some of the WIP is going to be converted to finished good. And at the end of the period, we might still have some WIP in inventory. And then the finished goods, you're right, to your point, you're right, those finished goods are going to be sold. And that's when the inventoriable costs become the cost of goods sold. Remember we said it's inventoriable cost. We don't reflect the cost until we actually sell the items, and because of the matching principle in accounting. Which means that the period in which we have the sales is the period in which we should reflect the expenses. Isn't that right?
Yes. Can you write down on the board? If you sold something, if you sold something.
All right, so now the next step. Well, what's that, David? Tell us what's the next step here. Then we got to do the reconciliation, right?
You already done. This is reconciliation, 599, and we can.
All right, but let's write it out nice and clear, so we're all on the same page here. Total cost to be accounted for. Is this 599,780? All right, then we have the cost of the WIP at the end of the period, which we said was 47,280. Cost of units completed and transferred. $552,500. Total cost accounted for. So this reconciliation, the reason why we do this, this is our check. So we know that we're trying to solve for this. We know that our total costs are $599,780. But the question is, what amount or what percentage of those costs are WIP and what percentage or amount is finished good? Yay.